two people start with the same $50,000. Same age, same city, same income. One buys a rental property, the other invests in index funds. 20 years later, one of them ends up significantly wealthier, and it's probably not who you think, and definitely not for the reason you think. And the reason why is quietly costing people hundreds of thousands of dollars without them even realizing it. And almost nobody runs these numbers properly. So today, we are. Not the Instagram numbers, not the financial guru numbers, the real numbers, the uncomfortable ones. I'm Frugal Fred. I don't do hype. I don't do guesswork. I run the numbers most people avoid. Because if you don't run the numbers will run you. Let's get into it. And we'll start with the version of this story that sounds really good on paper. Adam and Alexa both have $50,000. Same income, same starting point. The only difference, what they do next. Adam buys a rental, Alexa buys index funds. And this tiny decision quietly determines how hard their money has to work for the next 20 years. And by year 10, something happens that almost flips this entire outcome. Adam, $50,000 down, $250,000 property, mortgage, $1,330, rent, $1,800, profit, $470 per month. That sounds great until you stress test it, and most people don't. And this is exactly where most people stop thinking and start losing money. Adam feels like an investor. Alexa, she invests and nothing happens. No status, no excitement, which is exactly why most people miss what happens next. So let's look at Adam's first year, year 1. Rent, $21,600. Mortgage, $15,960. Looks like profit. But taxes, $3,000. Insurance, $1,500. Most of it is gone. And we're still not done. Water heater breaks, $1,200. Cash flow, gone. So that $470 per month? In real life, it's often closer to zero. And in some years, it's negative. And there's one risk that almost nobody talks about honestly. A bad tenant, someone who stops paying but doesn't leave. Now you're covering the mortgage, the taxes, the insurance, and getting zero income. And depending on where you live, that can last months. That one situation alone can erase an entire year of profit. At the same time, Alexa hits approximately $55,000. No effort, no stress, no decisions, which turns out to be her biggest advantage. Good investments survive math. Bad ones survive marketing. Adam has leverage. $50,000 controls $250,000. 4% growth equals $10,000 gain. That's powerful. This is why real estate builds wealth, but it also amplifies mistakes. And to be fair, skilled investors can outperform this by a lot, but that usually takes more time, effort, and experience. Vacancy, 1 month empty equals $0 income, plus $1,500 to $2,500 in real cost. Maintenance, $2,500 to $5,000 per year. Big repairs, $7,000 HVAC. No warning. If you're not accounting for this, you're not calculating returns. You're not investing, you're guessing. Capital expenses, roofs, furnaces, appliances, not if, when. So up to this point, Adam has more control, but more problems. Alexa has less control, but zero friction. Fast forward a few years. Adam's real return, remember that $470 per month? After everything, it's closer to 3 to 5%, which means after all that work, time, and risk, he's performing roughly in line with the stock market on a pretty average deal. And this is the number almost nobody wants to admit. Alexa, $135,000 to $150,000. Compounding is accelerating. Money making money. If you check your money constantly, real estate will feel safer, even if the numbers say otherwise. And this is the difference most people miss. Real estate is like owning a machine. It works, but only if you constantly maintain it. Index funds are like planting a tree. Leave it alone, and it grows. By year 10, most people think they know who's winning, but this is exactly where those assumptions break. Adam, approximately $170,000 equity, plus $20,000 to $35,000 additional costs. Alexa, approximately $165,000 to $180,000. Same result, completely different effort. Adam, $450,000 to $500,000 equity. Extra profit after everything, $40,000 to $80,000 total. Alexa, $420,000 to $460,000. Same destination, different lives. Adam worked for it, Alexa waited, and this difference matters more than most people think, because Adam's investment doesn't just exist on paper. It shows up in his life, late night calls, weekend repairs, unexpected problems. It's not just an investment, it's a second job. Alexa's investment, it doesn't interrupt her life. It doesn't call her. It doesn't demand anything from her except patience. If you judge this purely on effort versus outcome, Alexa wins. On effort versus outcome, it's not even close. And for most people, that's what matters. But only if she stays invested, because most people don't. Imagine watching your $150,000 portfolio drop to $95,000 in a matter of months. That's what happened in 2008. And most people didn't calmly hold. They panicked, they sold, they locked in the loss. That's why the average investor underperforms. Not because the market fails, but because they panic at the worst possible time. Most people don't want the best investment. They want the one that makes them feel smart. Alexa increases to $500 per month, $550,000 to $600,000. Small changes early, massive differences later. Real estate scaling, more properties, more debt, more time. Stocks crash. In 2008, minus 37%. In 2020, minus 34%. People panic, sell, lose. Real estate, stable, tangible, cash flow, tax advantages, control. There's also something else most people don't factor in: concentration risk. When Adam bought his property, he didn't just invest in real estate. He invested in one property, in one neighborhood, in one market. If that area declines, if demand drops, or if something changes locally, his entire investment feels it. Alexa, on the other hand, isn't betting on one company or one location. She owns tiny pieces of hundreds, sometimes thousands of businesses. If one fails, it barely matters. That level of diversification doesn't feel exciting, but over time, it quietly reduces risk in a way most people underestimate. Most people who say real estate is passive have never managed a property. Both work, both fail, if done wrong. Real estate wins if you treat it like a business. Stocks win if you stay consistent. But the real trap? Making the decision based on hype. And now you see why the obvious winner isn't so obvious. Real estate trades time for control. Stocks trade control for time. If you're someone who values your time, doesn't want complexity, and just wants steady growth, index funds are usually the better fit. If you don't mind risk, unpredictability, and treating this like a business, real estate can make sense. If I were starting with $50,000 today, I'd focus on building a strong base in index funds first, then consider real estate once I have more flexibility. And here's something most people don't consider. This isn't actually an either-or decision. Some of the most financially stable people do both. They use real estate for leverage and income, and the stock market for long-term growth. That combination changes the math in a big way. So here's what actually matters. Which one can you stick with for 20 years? Because the best investment isn't the one with the highest return, it's the one you can stick with when things get uncomfortable. If you had $50,000 right now, are you going real estate or index funds? And more importantly, why? If you want more breakdowns like this, real numbers, no hype, hit subscribe, because most people aren't bad with money. They're just working with bad math and bad assumptions.